Welcome back to the channel. As always, if you are copy trading, you're an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to look today at a stock called Upwork, ticker UPWK. And you probably have heard about this company. They provide freelance services, right? Where you can hire a consultant for a gig, as it's called, to do a certain job. And has not been around for that long. So since 2019, you see, we are sitting in a bit of a head and shoulders pattern, if you will, when you look at long term. However, if you look at it a little bit closer, right, year to date, the stock is already down quite a bit. And one of the reasons why I'm considering this as a long is that I am actually quite surprised to see the performance of this stock considering the expectations that it has for the future, as well as the performance that has shown over the last few quarters. So, and the last quarter that they had, uh, you can see that it was pretty positive. So overall, they've been having a pretty successful run, arguably since mid-early 2022. But if you see the last quarter, beat on sales, beat on EBITDA, EBIT, EPS, and EPS gap. So overall, pretty successful. And what's interesting to me is that, so that happened on the 1st of May. Let's see what the stock has done since then. So 1st of May, earnings come, initial reaction, upside, and then there's a bit of a downtick to levels that the stock was not before. So it's quite interesting to see that because even though it was pretty positive, the market reacted in this way with a significant uptick on short interest shortly before that announcement. And to me, that tells me a couple of things. The market's still not feeling hot about this stock, and that's probably why I'm going to keep it on the watch list and wait for better timing and technicals. But I do see things that I do like when I look at what they've been doing. So first of all, let's look at how it's performed quarter on quarter. You see that there's been growth, right, year on year, but also quarter on quarter metrics such as revenues and gross profit margin keep getting better. Same thing goes for EBITDA margin. It keeps getting better and better. Income, slightly improvement as well. And yeah, we don't see a lot of negative stuff over here. So in the last quarter, and I think I have the earnings report around here. That's right. A few things that are quite interesting is so 19% year-on-year revenue growth, and they alluded to, right, changes in how AI is propelling the business forward. They also pointed at raising EBITDA guidance for the year, but more importantly, having found ways to reduce the costs that long term gives them confidence that they can achieve a 35% adjusted EBITDA margins within the next 5 years. So that's pretty bold prediction to make. When you look at the EBITDA margin currently being 7%, right? So we're talking about like a 5x improvement in margin expansion. Now, again, they said within 5 years, so this is the reason why I'm going to keep this on the watch list. But I do think that as the year goes by, we could see this stock moving up quite rapidly. So look at, for example, the expectations are for this year. The company is expecting a 76% increase on their EPS, and that's even more impressive when you look at the GAAP guidance. It doesn't have too much debt, And in terms of how the analyst community feel about it, it's actually pretty positive. So 8 upwards revisions on the EPS versus 0 down, 9 up for revenue versus 1 down. So overall, the analyst community feels pretty good about this stock. And something that I find quite interesting is that when we look at peers in this sector, a good number of them are trading below the 1 billion market cap. So I think that's a positive for Upwork versus some of its peers, because even though arguably this direct competitor of them, the closest one, Fiverr, is doing quite all right too, they don't have the market cap which gives them the exposure for the investment community to get involved with these kind of names. And if we look at a valuation perspective, so companies trading at the moment at 11 times next 12-month PE. So we see how that historically has been very competitive, but by any standards is quite good. So we can have a look as to how that compares, for example, to Meta, which we could use as a bit of a proxy. And Fiverr sits just below that. Now, the interesting thing to me is that Upwork comes from a much higher base in the near term, and Fiverr has kind of remained stable with Upwork getting close to it. If we were to look at some of these names that I just had a look at, we cannot really say that this is a valuation that is over the top or unreasonable. So let's look at some other names here. We got Sterling, above, Kforce, this is the company HRT, and then we got Fiverr as well. So it's quite interesting to see that without meaningful catalysts or drivers that had led to this decrease in valuation, we're currently sitting kind of at the bottom, but not the lowest. And I think there's room for this valuation to pick up back to, these levels over here, maybe 13 times, maybe 15, where it was not so long ago. We also have to bear in mind that there's going to be margin expansion, or the company is expecting so to happen. So it wouldn't take, a massive increase in multiple to drive the stock price higher. Now, why this particular company? Because we are basically, if we are considering this as a long, saying I want to go along a company that the stock market is paying not a great valuation for, is not being recognized at the moment. Well, let's dig a little bit farther, because admittedly we could be considering Fiverr too, which also has interesting metrics. But in this particular case, I think doesn't offer such a compelling story. So first of all, the company had a pretty good moment in May, but has remained stagnant ever since, and still kind of sitting in this downward trend. Now the company has been doing okay. If we look at the figures, the numbers are also positive, but not as impressive as the ones that we have seen with Upwork. So for example, EBITDA margin continues eroding, and the net income margin growth as well seems to be slowing down a little bit. I had a look at the earnings report as well, which can be found here. But overall, I just haven't seen things that get me as excited in terms of performance compared to Upwork. And I'm going to show you now one of them that I think is key. This took me a little bit of time to put together, but I think is worth comparing. So I have summarized here the KPIs that are used by these companies. Let me zoom in a little bit. That's better. So this is the take rate, okay? And the take rate is, let's look at the definition. So commission or fee charged by third-party platforms or marketplaces for the services, usually collected as a percentage of the gross merchandise value. So there's some examples here, but the point is that we are comparing like to like these two companies, Upwork and Fiverr. And so I've gone into the filings and gathered the take rate that they have been growing over the years. Now, arguably, Fiverr has a take rate that is at the moment around double or just under compared to Upwork. But the growth at which Upwork has been growing over the last few quarters, over the last three actually, is outpacing Fiverr and is actually growing quarter on quarter. So year on year. So it went negative in 2021 and then went back to the growth that we saw in 2020 in the middle of the pandemic when things were going pretty well. It actually exceeded that and it has continued to grow ever since. So it managed to grow in 2022 in a bear market, 2023, not an easy year, but almost tripled that performance. It continues to grow farther. This is as of the first quarter of 2024. So it seems to me that things overall are going pretty well for this company, for Upwork. Now, Fiverr has been doing okay too. So as I said, they have a take rate that is currently double, but it's not growing as fast anymore. So you can see here that the growth rate is now slowing. And if we look at the year on year, right, with that comparable 2023-2029 period, they're about the same. But you see how when we add the same period adjusted for that Q1 2024, we get a much more interesting growth rate for Upwork. Same if we look at all time that I managed to find as far as 2016. Not so representative here since the sample is a little bit smaller. But if we include that again, it's definitely quite significant if we include that first quarter of the year. So I think that's quite interesting. And I think that trend may continue because the company is alluded to the measures that have led them to increase their profitability. Now, let's not forget that this is the kind of tech company that you would think would struggle quite a bit in the environment that we're in with with high interest rates. But that has not really happened here. So overall, having gone through this this bear market in 2022 and then remain in 2023 with the high interest rates, the company has actually been doing okay. So I think this is something that is worth looking at. I don't think the market is fully on board with the story just yet, and that's why I decided to keep it on the watch list. Potentially as well, because I would be looking to play this with options. I would prefer to enter below the $10 mark because that's what the chain levels are. And who knows, maybe if there is a market downturn over the next few weeks, if the Fed throws some comments that catch the market off guard, potentially even better at the 750 level. But I think it's more likely to play the $10 strike. And with that note, something that I quite like about this stock is that it has plenty of volatility. and it provides a very interesting structure to play a calendar. So I would be selling probably the 10s expiring in July at 110 and buying the 10s in October at 180. So that is a pretty good credit debit profile, still with plenty of volatility. The short leg expires before earnings, so it provides a lot of upside. We could even still consider doing that on a one-to-one ratio if maybe the price is a little bit better, but still on a ratio works pretty well. So one for the watch list. We'll keep an eye on it, and I want to see the market getting a little bit of traction with it before I enter. So I hope you enjoyed that. See you soon. Bye bye.